Alright, so let's get right into this because this is absolutely fascinating. Warren Buffett, the man, the myth, the legend, bought his very first stock when he was just 11 years old. Now you'd think starting that early would give him an insane head start, and it did, but not in the way you'd imagine. Because even though he was in the market before he was even a teenager, it took him another 8 full years, all the way until he was 19, to finally grasp the fundamental principles of how investing actually works. And once he understood it, everything changed. Today the man is worth well over $100 billion, a testament to the power of getting the basics right. It's not about complex algorithms or risky bets, it's about a core philosophy. So what was the big secret? What was the light bulb moment that took him from a kid buying stocks to the Oracle of Omaha, one of the wealthiest people on the entire planet? Believe it or not, it wasn't some proprietary trading software or some insider tip from Wall Street. It all came down to 3 incredibly simple yet profoundly powerful rules that he learned from a single book. That's right, one book changed the entire trajectory of his financial life. It's almost unbelievable that the foundation for a $100 billion fortune could be distilled down to just a few core ideas that literally anyone can read and understand if they just take the time to do it. If you're watching this right now and you're a beginner, maybe you've just opened a brokerage account, or you're thinking about investing your first $100, this is for you. You're in the exact same position Buffett was in before he had his breakthrough. You're about to learn the very same foundational rules that shaped the mind of arguably the greatest investor in modern history. These aren't just tips, they are the bedrock principles that allowed him to consistently beat the market for decades, building unimaginable wealth from the ground up, and doing it in a way that's surprisingly low risk, if you follow the logic. And honestly, you don't need an MBA from Harvard or a degree in finance to understand this. That's the real beauty of it. These rules are based on logic, common sense, and a business-like mindset that anyone can adopt, starting today, with whatever amount of money you have. By the end of this video, you'll have a framework that cuts through all the noise, all the get-rich-quick schemes, and all the confusing jargon. You'll have the 3 simple rules that Warren Buffett himself has used for over 70 years. So, with that said, let's get into the first rule, because this one is the absolute cornerstone of everything else. The most important rule to burn into your brain is this: a stock represents ownership in a real business, not just a ticker symbol or a lottery ticket. When you buy a share, you become a part owner entitled to a fraction of its profits and future growth. Stop thinking like a trader and start thinking like a business owner. If you were buying a local business, you'd do your homework. Buying a share of Microsoft is the same, in principle, as buying that local coffee shop. Focus on the long-term performance of the business. Imagine buying a gas station. You'd analyze its financials, competition, and management. This is fundamental analysis. Making informed decisions based on the company's health and prospects. Invest within your circle of competence, businesses you understand. Look for revenue growth, consistent profitability, and positive cash flow. Adopt a long-term perspective. This allows compounding to work its magic. A long-term mindset helps you weather market storms. A stock is a business. Master this rule and you're ahead of the game. Alright, so you've done your homework, you've found a wonderful business you understand, and you've bought a piece of it. You're officially a business owner. Now comes the hard part: dealing with the day-to-day madness of the stock market. This brings us to Buffett's second rule, which is to not listen to the market. To explain this concept, his mentor Benjamin Graham came up with a brilliant metaphor: a character named Mr. Market. And understanding this character is the key to mastering your own investment psychology, which is honestly half the battle. Imagine you have a business partner named Mr. Market. The two of you own a great company together. The problem is, Mr. Market has some serious emotional issues. He's a manic depressive. Some days he shows up at your door feeling incredibly euphoric and optimistic about the future. On these days, he'll look at your shared business and offer to buy your half for a ridiculously high price. He's so excited he's willing to pay way more than the business is actually worth, convinced that things can only get better from here. He's practically throwing money at you. Then, on other days, Mr. Market shows up completely despondent and pessimistic. He's convinced the world is ending and that your business is doomed. On these days, he's in a panic and offers to sell you his half of the business for a ridiculously low price, far, far below what you know it's truly worth. He's so terrified that he's willing to take a huge loss just to get out. He doesn't care about the long-term value, he just wants cash right now, because he's convinced everything is about to collapse into a fiery inferno. Now here's the most important part of the story. Mr. Market shows up every single day without fail, offering to either buy your shares or sell you his. But you are under absolutely no obligation to trade with him. You can completely ignore him. You can tell him to come back tomorrow. You, the intelligent investor, have the power. You can choose to take advantage of his mood swings, or you can simply shut the door and go about your day, confident in the value of the business you own. The market is there to serve you, not to instruct you. This Mr. Market character is, of course, a perfect metaphor for the stock market itself. The daily fluctuations in stock prices are nothing more than Mr. Market's mood swings playing out in real time. When the news is good, the economy is booming, and everyone is optimistic. You get these euphoric periods where stock prices get bid up to insane levels. This is Mr. Market in his manic phase, offering to buy your shares for far more than they're worth. Think about the dot-com bubble in 1999 where companies with no profits were trading for billions of dollars. That was pure euphoria. Conversely, when there's a crisis, a pandemic, a war, a recession, a financial panic, Mr. Market gets incredibly depressed. Fear takes over and everyone rushes to sell, regardless of the underlying value of the businesses they own. This is when he shows up at your door, offering to sell you his shares for pennies on the dollar. Think about the market crash in March of 2020, or the financial crisis of 2008. During those times, you could buy shares in fantastic world-class companies for prices that were absurdly cheap, simply because Mr. Market was in a state of total panic. The mistake that most beginners and even many professionals make is that they let Mr. Market's mood dictate their own. When he's euphoric and prices are high, they feel FOMO, the fear of missing out, and they rush to buy in at the absolute peak. They get swept up in the excitement. Then, when Mr. Market gets depressed and prices crash, they panic and sell everything at the bottom, locking in their losses. They are, in effect, letting a crazy person make their financial decisions for them. They buy high and sell low, the exact opposite of what you should be doing. Buffett's advice is to do the opposite. You should view Mr. Market not as a guide to follow, but as an opportunity to exploit. Your job is to remain rational and detached from his emotional roller coaster. You have to separate the price of a stock, which is determined by Mr. Market's daily whims, from the value of the underlying business, which you have determined through your own careful research based on rule number 1. The price is what you pay. The value is what you get. And very often, because of Mr. Market's emotional problems, the two can be very, very different. The key to successfully ignoring Mr. Market is to have done your homework in the first place. Your defense against his emotional manipulation is your own independent analysis of the business's value. If you haven't done the work to figure out what that gas station is actually worth, then you have no anchor. You have no basis for your decisions other than the price you see on the screen. And when that price starts plummeting, you'll have nothing to hold on to, and you will panic along with everyone else. Your conviction comes from your own research, not from the market's opinion. Think about it this way. Let's say you did your research and determined that your gas station business is worth about $1 million. One day, a euphoric Mr. Market offers you $2 million for your half. As a rational business owner, you might be tempted to sell. That's a fantastic price, double what you think it's worth. You can take advantage of his good mood. Another day, a depressed Mr. Market offers to sell you his half for just $200,000. Knowing the business is worth $1 million, you would jump at the chance to buy his half at such a steep discount. You'd be taking advantage of his bad mood. This is precisely how Buffett operates. He famously said, "Be fearful when others are greedy, and be greedy only when others are fearful." This is just a different way of saying you should sell to a euphoric Mr. Market and buy from a depressed Mr. Market. When the stock market is soaring and everyone is bragging about their gains, that's the time to be cautious. And when the market is crashing and there's blood in the streets, as they say, that is the time to be looking for incredible bargains in great companies. This is incredibly difficult to do in practice. It goes against every human instinct we have. Our brains are wired to follow the herd. When everyone else is panicking, our natural inclination is to panic too. When everyone is getting rich, we want to join in. That's why having a rules-based system is so important. It provides a logical framework that you can fall back on when your emotions are trying to take over. Your rule is, I will only buy a great business when Mr. Market offers me a price that is significantly below my calculated value. This simple rule protects you from your own worst enemy, yourself. A direct consequence of ignoring Mr. Market is that. Let's get into the third and most important rule from Warren Buffett: margin of safety. It's the ultimate financial cushion. Buffett learned this from Benjamin Graham, the godfather of value investing. The margin of safety is the gap between the price you pay and its intrinsic value. Wait until a $100 stock is available for $75 or even $60. Your margin of safety allows the investment to underperform and still not lose you money. Buffett says to think like an engineer building a bridge. A smart engineer would build that bridge to handle far more weight than needed. That is how you need to think about your investments. This brings us to the difference between price and value. Price is what you pay. Value is what you get. The magic happens when you can buy a great business when its price is temporarily depressed. You are creating a scenario where the potential upside is much greater than the potential downside. It gives you room to be wrong without being financially penalized. It is a get-rich, slowly and surely strategy. So, as we wrap this up, I want you to take a step back and think about these three simple rules from Warren Buffett. What's the biggest takeaway here? For me, it's this. You don't need to be a genius to invest successfully. You don't need a PhD in finance. You don't need to understand complex algorithms. And you certainly don't need to be glued to financial news channels 24/7. What Buffett has proven over a lifetime of success is that investing is not a game of IQ points but a game of temperament and having the right framework for thinking about things. You don't need to trade every day. In fact, Buffett would argue that the less you trade, the better you'll likely do. The constant buying and selling, trying to time the market's every little wiggle, is a fool's errand that mostly just enriches your broker through commissions and yourself through taxes. The goal isn't to be active, the goal is to be right, and getting it right doesn't require hundreds of decisions. In fact, Buffett himself has said that you don't even need more than a few good investments in your entire lifetime to achieve incredible financial success, as long as you make them with care and conviction. So, if you don't need to be a genius or a hyperactive trader, what do you need? It really boils down to just three things. First, you need a business mindset. The ability to look past the stock ticker and see the real, living, breathing business underneath. Second, you need patience. The discipline to wait for the right pitch and to let your investments compound over time without getting spooked by market noise. And third, you need discipline, the emotional control to stick to your principles, like demanding a margin of safety, even when everyone around you is chasing the latest hot trend. These three simple rules turned a curious 19-year-old who read a book by Benjamin Graham into one of the richest and most respected investors in human history. They are not complicated, they are not secret, but they are incredibly powerful. They can help you build wealth too, slowly, wisely, and with a sense of confidence that you're making sound decisions for your future. It's about playing the long game, and with this framework, it's a game you can win. Thanks for watching, and as always, don't forget to obliterate that like button and subscribe for more content just like this.